So what I'm talking about right now is capital and interest, and I just want to warn you, this topic is a bit daunting, so of course I'll do my best to just give you the basics. That's what we're doing these first 2 days, is give you the bare bones, what you need to know, so that later on when you choose the lectures that interest you, you have the foundation to build on. Capital and interest theory has been called the black hole of economics, so for those of you who are geeky like me, we'll try to stay outside the event horizon. Little physics joke for you. And another illustration of just how dangerous it is to lecture on this topic. When I was giving my job talk when I taught at Hillsdale College, when I first started there, and they were interviewing me to see if they wanted to hire me, you're supposed to give a sample lecture just so they can see what your research is. And I really didn't have anything published except what my dissertation was. And so I talked about capital and interest theory. And the accounting professor was in that crowd. And he was a very athletic guy that he would bike to work every day. You know, he'd have the tight spandex shorts on and be walking around and turn the heads of the young freshmen and so on. And he was serious. He even had the helmet that had the rear view mirror. Have you seen these? That the bikers, they had the little helmet so they could see the cars behind them. And so he had this watch that would keep track of his heart rate. And he told me after they hired me and we were better friends, he said, you know, Bob, during your lecture there where you're teaching us about the capital and interest, I looked down at my watch, and at that moment that was the lowest my heart rate has ever been that I've ever seen. And so hopefully, I think that's probably why they put my lecture right before dinner, so that when you start going into a coma, they can get you out and give you some food into you. So we're talking about capital and interest theory, and I think what we need to do first of all, because I realize some of you have never perhaps received formal instruction, or at least instruction along the lines of Austrian economics, is let's just start out and go through some basic definitions. Okay, so, and we always try to adjust, and it's just the way it is up here. Okay, so you can see that it says capital goods, and the standard definition you'll see is something along the lines of produced means of production. And so let's parse this definition out. So first of all, this phrase here, means of production, that means in contrast to means of consumption or consumption goods. So what we're saying here is for something to be considered a capital good, it has to be a factor of production. It's not the final consumption good. If something's a consumption good, it can't be a capital good, at least in that one instance. And then the other part of the definition, this word produced, that means as opposed to just appearing in nature. Okay, another way of saying it is man-made factors of production. That would be an alternate definition. Now, having said that, let's just take a little bit of time here to go through some of the nuances of this. For example, this word produced, and here I don't want to dwell too much on this, but strictly speaking, that's not really what's required. Really, the term would be would be reproducible. Let me just give you an example so you understand what I'm talking about. You can imagine a tribe where they go out and they cut down branches from trees and they sharpen them, and it turns into a spear, where they take the branch and they perform labor on it and turn it into a spear. So clearly that spear is a capital good, and it was man-made by the tribesmen. But what if a freak bolt of lightning happens to hit a branch, or maybe some beavers are working on a branch, and they turn it into such a physical thing that, from the tribesman point of view, nature has provided, and it's indistinguishable from the man-made spears? Well, you'd be hard-pressed to say, well, that's not a capital good, that's a natural resource, whereas this is a capital good, because they're interchangeable, right, that no one can tell the difference. So that's why Rothbard, in a very technical part, he says, really what we mean, instead of putting this word produced here, strictly speaking, it would be something that's reproducible. Now, this other phrase, means of production, there I want to stress that this is not an objective criterion. It's not that you can just look at something and tell, is that a capital good or a consumption good, without knowing the plan that it's going to be used for, or the purposes of the actor who owns it. Just to give you a few quick examples, let's take the Diary of Anne Frank. Okay, and I don't mean the book that has that as the italicized title. I'm saying the actual physical thing that was Anne Frank's diary. You can say, well, is that a consumption good or a capital good? And it depends. You can say, well, and from whose point of view? That from the girl's point of view, it was a consumption good, just like your own diary. You went to the store and you bought the blank one, and every day you write in it, that's clearly a consumption good, a durable consumption good. But from the point of view of the publisher, who after the war may have gotten his hands on Anne Frank's diary and starts looking through it and says, wow, is this authentic? We're going to make a ton of money off of this thing. It's clearly a capital good. It's a means to an end. All right, so that's what I mean when I say that the definition of something as a capital or a consumption good, it's itself subjective. It's not an objective thing that you can classify. All right, that you need to know what are the subjective intentions of the people using the item in question. To give you a different example to show it's not even just a matter of which person are we talking about. It could be the same person, and once his or her anticipations or plans about the future change, the same thing all of a sudden could flip from one to the other. So you can imagine a guy leaning up against a building, he's strumming his guitar, and he's just minding his own business. He's playing it because it gives him happiness to strum the guitar. It's a consumption good. But people start walking by, they like the music that he's playing, they start throwing money at him, and all of a sudden if he says, I could make a lot of money doing this, and I think every day from now on I'm going to come here at this hour when people come out for lunch or whatever and get a lot of traffic on this corner, and I'm going to play these songs, all of a sudden that guitar, which 10 minutes before was clearly a consumption good, now all of a sudden is a capital good, because now it's a factor of production in his business of trying to sell musical services to walkers on the street. Okay, so that's the sense in which just about everything we do here this week will ultimately be related to the subjective intentions of individuals. And that's why we like to say that Austrians are more subjective than basically every other school of thought, because we push the subjectivist viewpoint more fully than probably just about every other school. And for those schools that might push it more, they're wrong. So they push it too far. So we're just right. Okay, now in contrast to capital goods, there's this other definition of just capital, or if you want to have two words, you could say financial capital. And this definition is the total money associated with an enterprise after selling all the assets and then with the money you raise paying off all the liabilities. Okay, so you might say it's the net worth associated with some enterprise. That would be how much financial capital is tied up in it. Now, a lot of times people will use the same word capital for both of these ideas. And the Austrians, particularly Ludwig von Mises, are very careful to keep them distinct. That capital goods, if what you mean are the physical objects, then you should call them capital goods, because if you just say the word capital, it's liable to confusion. And the problem is, or let me just give you an example to show the difference to make sure you're following me. So if you're talking to somebody and he owns a laundromat, and you say to him, how much capital do you have invested in your business? He's probably just going to give you a number back and say, whatever, $340,000. And what he means is, if I were to, or one way of defining what does he mean by that, he could say, well, if I sold off all of my assets associated with that business. So he's not talking about his house, because you said how much is invested in that particular business. So all the things that are associated in his mind with that business, if I sold off all the assets, got a bunch of money, but then also paid off any debts that were associated with that business, whatever was left over, that's how much I have invested. And so then he could look at how much he earns year after year and then see what's my rate of return on investing in that store. Okay. Another thing he could say is, if you say, well, what sort of capital goods do you have invested in that business? And he could say, oh, well, I have all the washing machines, I have the dryers, I have the vending machines that spit out the single servings of the detergent and the dryer sheets and things like that. And so there he's thinking in terms of the concrete capital goods. All right, but typically when we talk about capital and investment, we usually mean, especially if you're just talking in everyday conversation, if you're not an economist, you probably mean the second definition. But the problem is economists will often, in an argument, they'll flip back and forth between the two meanings without being clear. And that's what leads to a lot of fallacious arguments as far as the Austrians are concerned. And we'll get to one example, at least, of that later on in my lecture. And probably later in this week, a lot of illustrations of this will come up. Even here, again, just to belabor the point, again, this is really, it's not a, here it's clearly has to do with not just the physical characteristics of something, but the subjective plans, not only of the individual, but of everybody else. That clearly, in order to apply this definition, you need to know what the market prices are, or more specifically, you need to know the likely prices you would fetch if you were to go out and sell everything, all these assets. And so it only even makes sense to talk about financial capital in this sense if we're talking about something in a market economy. All right, and Mises, he basically goes so far as to say that a socialist community could have capital goods. There could be tractors, and there could be drill presses, and there could be assembly lines, things like that, in a socialist community, for sure, that could happen. But it would be only really metaphorical to speak of how much capital is in a socialist community, because they wouldn't have market prices, and so they wouldn't even be able to apply that definition. And it's nonsensical to say, oh, but what if they were to apply? What if we imagine what the prices would be? And you could sort of push it and say, well, so maybe the capital does exist in a sense, but nobody knows what it is. I mean, you could take that fallback position. But I think Mises himself would go for the more radical interpretation to say, no, it doesn't really make sense to say the capital, the financial capital, that sum of money exists, that you could say how much is this socialist tank production plant, how much capital is invested in it according to their 5-year plan, even though there are no market prices. That's a nonsense statement, and to back that view up, because remember, it's not that you're pointing to some external thing of the world. You're talking about when the entrepreneur appraises in his mind the assets and the liabilities, what number does he associate with this firm? And to say, well, that number really exists even though we don't know what it is, that's a bit odd to say that, you know, what would the number be that I know if I didn't know it? And so that's, I think, why Mises takes that, what some might view as a very strong, strident position, that really capital doesn't exist in a socialist community, even though capital goods do exist. And this goes to Mises's point where some of you may know that Karl Marx actually, I believe, coined the term capitalism in describing the private property system or free market economy. Karl Marx was the one, or at least one of the first, to describe that as a capitalist system, but he meant it as a smear, that he wanted to contrast it with socialism. So if you just forget for the minute everything, your knee-jerk hostility to the term socialism, just think about the words. A socialist system allegedly caters to all of society. It's a system that serves the interests of society. And oh, isn't that nice? Whereas what does a capitalist system do? Or under capitalism, it serves the interests just of the capitalists. And so, well, that doesn't sound like a very nice system at all. And so that's why Marx chose those terms. He was trying to show that the private enterprise, free enterprise system only serves the interests of a narrow capitalist class. But Mises, acknowledging this historical fact, said, even so, it's a pretty good term because it's precisely under a private property arrangement where individuals own the means of production, and so you have market prices. It's only in that type of arrangement where people can engage in cost accounting and can keep double entry bookkeeping and can come up with associated amounts of capital and apportion them to various parts of a firm, or compare the amounts of capital invested in various enterprises. And so Mises thought that, ironically, Marx's term was a good one, even though Marx meant it as a criticism or a pejorative term. Now this leads into the classical view. And again, what I'm doing here is I'm just trying to give you a very general introduction to capital and interest, and then after I get through this, I'll focus on the Austrian approach. So here, this is the classical view, where, and by classical economists, I think Dr. Salerno talked about this, but I mean people before the marginal revolution, people like Adam Smith and David Ricardo. So here, they thought there were 3 factors of production: land, labor, and capital. And then I have in parentheses here natural resources, because they didn't just mean actual land. They also meant things that nature provides. So deposits of oil or tin, things like that, would be considered land in this division. Labor is labor, as we know it. And then capital, they would just call it capital, but I've got goods here with a question mark, because depending on the author, depending on the passage you're reading, it might be clear from the context whether they meant capital or capital goods. But given this distinction that they would draw, then over here I've got the income. And so they would say, okay, what is rent? Well, rent is the thing that landowners earn. And wages are the income that labor earns. And profit or interest, because the classical economists use those terms somewhat interchangeably, is what capital earns, or is the return to capital. All right, so this is the way that they thought about it. And even in modern usage, not in terms of economics, but just the way everyday people talk about it, you still see some remnants of this. So, for example, you pay rent to your landlord. All right, and of course, laborers still earn wages. and a lot of people still think that interest is what capital earns. All right, so this is the classical view, and just so there's no confusion, this is wrong. So don't come out of here saying, yeah, I dozed off, but I did take away this three-part factor income dichotomy. Okay, so this is wrong. Now there's a bunch of different ways of seeing why this is wrong, and if clearly in this lecture I'm not going to be able to give you the whole alternative view so that you could compare the two in your mind and see, oh, there's why this is wrong. But let me just give you an example that I'm adapting from Irving Fisher. Okay, so I'll read this in case it's hard to see in the back. So I have, suppose an investor buys a parcel of farmland for $100,000 and charges ranchers $5,000 per year to let their cattle graze on it. Okay, so he's got $100,000 in money, and he goes out and buys a piece of farmland, and then every year he still retains ownership of it, but he charges these ranchers $5,000 a year. So now the question is, what is the annual income of this $5,000? Should we classify it as rent, or should it be interest? I'll move that up so people in the back can see it. So let's just think about that. On the one hand, is it rent? Well, certainly you could make a good argument for that. You could say, well, it's land, and he's earning these $5,000 in a sense in rental payments from the people who are renting out his services or the services of the land. The people paying it probably, they pay rent on their apartments, and they might even view it as I pay rent on the land for my cattle to graze on. So certainly it seems like if anything should count as rent, it should be this, where a landowner is getting payments for the use of his land. I mean, if that's not rent, nothing is. But on the other hand, you could make a very strong argument that it should be classified as interest, because you could say to the landowner, why did you invest your money, your $100,000 in this parcel of farmland? Why don't you invest it in this bond that pays 3%? And he could say, well, because, look, this $100,000, I pump it into this piece of land, and I earn $5,000 a year on it, so that's a 5% return on my capital, whereas if I bought this bond that you recommended, I'd only be earning 3%, and maybe the bond's safer, but I'm pretty sure that I'm going to be able to get $5,000 or thereabouts fairly indefinitely. Out 20 years, I don't see any problem in that flow of income. And so if I can earn 5% interest on my money going through the farmland, why wouldn't I do that instead of earning 3% on the bond? All right, so you can see that it's the same flow of income. It's that same $5,000, but depending on your viewpoint, it's either rent on the farmland for its scarce contribution to production, and that's a perfectly valid way of looking at it, but it's also, in a sense, interest on the invested financial capital. And again, if you were going to try to decide how to invest your money, you would want to look at what's the rate of return on this particular investment. So the point isn't that it's one or the other, it's that if anything it's both, and what this is serving to illustrate is that this view really is inadequate, and you're just going to get tied up in knots if you try to separate out income in the world into these three different categories. So you don't want to do that. The classical economists were wrong, not only in the other ways they viewed the world that Dr. Salerno talked about, but also with this particular approach that they had. Now, a more politically incorrect example, this thing down here at the bottom, I said, what about a slave? A slave is even a better illustration that suppose you invested money and you bought a slave and then you rented him out to the plantation owner down the way. You could say, well, what would be that income? How would you classify it? Well, on the one hand, again, you're renting him out, so you might look at it as rent. On the other hand, you could say, well, the slave is performing labor, so in a sense, aren't those wages that are being paid? I mean, I'm stealing the slave's wages, if you want to look at it that way, but they are wages, right? But also, it is a return on the financial capital that I gave to the person who took the ship over here and sold me the slave in the first place. And so you can see that in that case, the same payment could be construed as any of these three different types of income. All right, so that's a good thing slavery's been abolished, because then we don't have to deal with this problem. What's that?
Instead we have student debt.
Oh, that's true. That's true. Okay, now the difference is the slaves actually produce something. Okay, so this is So that's a very general overview, and I should move on now. So that's, I want you to understand what do we mean by capital and interest, and now let's focus more on the Austrian approach to these topics. So my favorite Austrian economist is Eugen von boehm-bawerk, and he was after Menger but before Mises, if you want to look at it in that sort of hierarchy. And this is his area really, where he had the most seminal contributions in capital and interest theory. I'm not going to get into it too much right now, but there is, the consensus view now is that boehm-bawerk had some major mistakes in his work, but the stuff I'm going to talk about right now, everybody would endorse. Okay, so here we've got this diagram, and what I'm trying to illustrate here is how boehm-bawerk was viewing what the interest problem was. What did the economists need to solve in order to have satisfactorily explained interest from boehm-bawerk's point of view? Okay, so suppose on August 1st, 2007, you've got an entrepreneur and he pumps in $100,000 buying land, labor, and capital goods. Okay, so a bunch of inputs that he has some technological recipe he combines. There's this process of production that takes a year, and exactly 1 year later, August 1st, 2008, the consumer goods, shoot out the end of the production pipeline. And then he turns around and sells them to consumers for $105,000 total. So the question is, boehm-bawerk just, he looked around at the business place and looked at economic transactions over time, and he said, it seems that there is this definite regularity that time and again, business people who wisely invest their funds are able to earn more from the products that they ultimately yield than they pumped in initially. And this gives rise to what boehm-bawerk called originary interest. So in this example, this entrepreneur would have earned originary interest of $5,000. So again, just to belabor the point, I want to make sure I'm not losing anybody, it is the fact that when you buy inputs, generally speaking, the prices you pay in total for all of them are below what you're ultimately going to sell all the finished products for associated with those particular inputs. And so you end up earning what boehm-bawerk called originary interest. If you've taken microeconomics in college, this is what they might call accounting profit. All right, so it's how much more your revenue is than your explicit monetary costs were. So boehm-bawerk asked, why is this the case? Why are they able to do this? Because you would probably think, so long as people expected this amount, as long as this wasn't a surprise, why would entrepreneurs here, either this one or his competitors, why would they come in and bid away these scarce factors of production until their total prices equaled $105,000? Right? That if I told you there's a guy on the street corner selling apples for $1 a pound and a guy across the street is selling the same quality apples for $2 a pound, you would think, well, surely there's an arbitrage opportunity there. Why doesn't somebody buy low, walk across the street, and sell high until those prices become comparable? That you would think there must be some sort of institutional barrier, like maybe there's more demand on this side of the street and there's like a neighborhood gangs are preventing people from crossing over or what have you. But clearly you would think there's something that needs to be explained to show why these price differentials don't get obliterated. And the same thing here, boehm-bawerk thought prima facie there should be, this gap shouldn't exist. That if I'm pretty sure I can earn $105,000, why isn't this bid up? And you could say in any given example, maybe there was uncertainty, maybe he was surprised by getting $105,000. But boehm-bawerk thought it just happens so often that businesses earn what we again would call an accounting profit, that he thought that no, there's something else at play here. It's not just that businessmen are routinely fooled and are pessimistic about the future. So one explanation for this was what boehm-bawerk called the naive productivity theory. Now, as you can imagine, since he's qualifying it as naive, he didn't agree with it. And the naive productivity theory went something like this. It said, the reason that you have this discrepancy, the reason that factors of production, or when you invest in them, you're allowed to earn a return, earn interest income, is because capital is productive. All right, so that's the explanation. Capital is productive, and that's why. And boehm-bawerk would quote many different authors, and there's all sorts of different variants on this, but I'll just keep it very simple for the purposes of today's lecture. All right, so that was the naive productivity theory. Now, what's wrong with it? Well, what's wrong is that boehm-bawerk said, wait a minute, what we're trying to explain, again, is why these things are undervalued. Why isn't it the case that entrepreneurs come into these markets and bid up the prices of these things to reflect, if you will, the full value of the consumer goods that they're going to yield? And so it doesn't make any sense to tell me that capital goods are productive. So, for example, I want you to understand where the naive productivity theorists are coming from. You might say, well, yeah, it makes perfect sense that if I'm a farmer and I go out and spend money on a tractor, and then you wonder, well, why is it that my yield, my crop yield goes up by more than the purchase price of the tractor? You say, oh, because the tractor is productive. That's why if I have $50,000 I've saved or $100,000 that I've saved up and I go out and I buy a tractor, it increases my crop yield, my revenues go up, and then I have more than $50,000 when all is said and done and the tractor wears out 10 years from now. I've got more money when all is said and done than if I hadn't pumped that into the tractor in the first place. And people say, why is that? Well, it's because the tractor is productive. That seems so obvious. And boehm-bawerk is pointing out that no, that's not obvious. That's a bad explanation, because the productivity of the tractor, the fact that you can yield more crops, harvest more crops with a tractor than without, that explains why you're paying money for it in the first place. It doesn't explain why the tractor is selling for less than what you expect its contribution to be. And another, just to drive the point home, the way to see it is the more productive the things were, the higher the rate of interest. What that would require is the lower this amount, or the bigger the discount from this number compared to this one. So here I picked the number so that there's a 5% rate of interest, that for a $100,000 investment you end up earning $5,000 for a 5% return. But if you wanted to increase the implicit rate of interest or the originary rate of interest, you could just knock this number down. And so according to the naive productivity theory, you would think that if people are earning a greater and greater rate of return, oh, then it must be because the capital is more productive. And yet what you would be saying is because the capital is more productive, that's why we're paying less and less for it. Or if you want to go the other way, you might say, well, no, if the capital is more productive, what would happen is this number would get bigger and bigger. And that's what would happen. And okay, fair enough, but again, the gap then between these two is still getting bigger. So whichever way you want to address it, if capital's productivity is increasing, then you would expect, according to naive productivity theory, that the interest return would be increasing. And yet that forces you to say that this undervaluation increases, or even that this price drops, the more productive the capital goods are. And that doesn't make any sense. All right, and there's a bunch of other clever ways boehm-bawerk showed what was wrong with this theory, but I'll move on. Okay, so he has knocked down the naive productivity theory. Okay, but that raises the question, okay, well then what is the right theory? And this is where we get to the Austrian view of interest. And simply put, move this up a little bit. Boehm-bawerk's explanation for interest was that present goods, other things equal, are more valuable than future goods. Now it sounds pretty straightforward, so let's just make sure, first of all, that we understand what he means by this claim, and then we'll talk about how does that solve the interest problem. So here we've got some illustrations that I've made. And as you can see here, I didn't outsource this. I did these drawings myself. I passed the savings along to you. Okay, so on August 1st, 2007, suppose you're presented with this. Actually, suppose you're presented with this choice, and let me just read this in the back. I'm sure it's hard to see. This is a house, and then this right here is an IOU that says 1 house in 12 months. Okay, so what this thing is a legally enforceable claim that you can buy on August 1st, 2007 that says if you own this piece of paper 12 months from now, on August 1st, 2008, you can turn it in and then we'll give you a house that's exactly as good as this house in terms of its physical characteristics. Okay, so now the question is, which do you value more right now? And so boehm-bawerk said for most goods, for most people, if you're holding everything else equal, the present good is more subjectively valuable than the future good. Forget money for the moment. Just if you had to choose one or the other, which would you pick? Boehm-bawerk said most people would pick the present good. All right, and now because of that, if you understand the way that subjective preferences manifest themselves in objective market prices, you'll understand why it is that present goods have a higher price. Okay, so for the same reason that if you say, why is it that a pound of steak is more valuable, has a higher market price than a pound of hamburger? Well, the first answer is, and again, goes back to Dr. Salerno and Dr. Herber's lectures today, the immediate answer is, oh, because people subjectively prefer steak to hamburger meat. Okay, now you can push that through and come up with all sorts of qualifications and to really understand why that is the case. But clearly, if consumers are paying more for a pound of steak than for a pound of hamburger, it's because they subjectively value the former more than the latter. They get more utility from the steak than from the same amount of hamburger meat. So the same thing here, if just at first blush, without pushing it for the moment and saying why is it the case, but just if it is the case that people prefer present goods over future goods, they would be willing to pay more for the present good than for the same thing available only at a future date. And so that's why here I've got, might be hard to see back there, $105,000 for the present house, the house available right now, whereas maybe you'd only pay $100,000 for that same physical house to be delivered in 12 months' time. Now let me just clarify something. For most of you that are fairly young, so you probably aren't dealing in financial markets, but for some of you who are older or people online who might be listening, in modern financial markets, when you buy a futures contract, this isn't the price that they're talking about. It's not that right now you give money so that in a certain amount of time the good is delivered to you with no further obligation on your part. Really what you do when you buy a futures contract or a forward contract is you're right now agreeing to a price that you will then, that amount of money you'll hand over in the future. Okay, that's not what I'm talking about here. I want to be clear. Here I'm saying, what if you could give money right now for the house right now, or give money right now for this claim, this piece of paper that you're absolutely sure you can then redeem later on for the house. Okay, for the purists out there, what this would be is like a European call option with a strike price of 0. That's really the only analog that I could find in modern financial markets for what this thing is. Okay, so I think most people would agree with that yeah, this is reasonable that you would pay less for a house that's not available until the future than you would for one right now. But if you understand that, well, now we can understand where interest comes in, because suppose we wait a year to August 1st, 2008, and you had put your money into this thing, and now it's a legal claim, a year passes. If you want to think of it this way, this thing matures now into a present house, and assuming people's preferences haven't radically changed, and there's not been massive inflation, we'll just say suppose the present house at that time is still selling for $105,000. Well, then all of a sudden, this thing that you paid $100,000 for now turns into a house that's worth $105,000, and you could sell the house if you wanted to, or you could sell this piece of paper 2 minutes before it becomes redeemable to somebody who would give you basically $105,000 for it. All right, so just going from some of you probably picked this up immediately, but I want to make sure it really clicks with you. Just going from the fact that people can have preferences over things in terms of their intertemporal characteristics, that the time matters, that I could say, yeah, I like the red sweater more than the blue sweater, but I could also say I like the present sweater more than the future sweater, or I like the sooner rather than the later sweater. Okay, so when something becomes available in terms of time is something that is potentially relevant, and boehm-bawerk said more often than not, people want it sooner rather than later. So if you grant that that's the case, then you can see why people would earn originary interest, because you put money into the thing that at that point is a future good, time passes and it matures into a present good, and it's worth more. All right, so this person would have earned $5,000 in investing in claims on future houses, if you want to think of it that way. And so notice here, this has nothing to do with production. Right, this is just a claim. This is just a a consequence of the fact that people value goods differently depending on when they become available in time. Okay, so here, clearly, if you wanted to explain that, you wouldn't say, because the piece of paper is productive, and that's why I put 100 grand into it, and later on I was able to get 105 out. That would be crazy to say that. And you might say, well, yeah, but it's because that maybe capital was involved in building the house. Well, I could change the example, and we could talk about something that was clearly available, that what didn't involve factors of production, just things that were available, things that were accruing naturally. Let's say, like if there was some fountain that was giving out certain water that people liked, and people sold claims on the water that was going to be shooting out of that fountain in 1 year's time. You know, you could still talk about, I could draw an example like that. So clearly there's not anything in terms of man-made production, capital goods involved, and yet you've got this intertemporal discrepancy, and you've got what looks to be like interest income. And so the point is, this isn't an illusion. That's what boehm-bawerk thinks is happening. If we go back up to here, to this example, okay, that the land, labor, and capital goods here that you paid $100,000 for, even though, in a sense, they represented a technological claim on this future consumption goods. Okay, so in the same way that that piece of paper, that IOU, the person who owned it associated it with a future house because he could legally turn it into a future house. By the same token, the people who buy these things, they're looking at them, if they have some formula in mind and they think they understand the laws of physics and chemistry, they think that that's a claim on future goods. But at this point, when you turn over the 100 grand, at that point, it's only, whatever this thing is, it's only a future good. It's not a present good. And so that's why you don't pay as much at this point as consumers will be willing to pay for it at this point. And that's where the discrepancy comes in. Okay, so that's the way boehm-bawerk tried to solve the interest problem. As he said, it has fundamentally to do with the difference between present and future, the valuations of present versus future goods. Now let me spend just a little bit of time on some of the controversies here, and then I'll move on to something that's easier for beginners to understand. Where the controversy, and so again, if you followed me up till now, that's great. If you lose me for the next 5 minutes, don't worry about it. This is more for people who have studied this stuff, and I just want to clarify some misunderstandings. So this was boehm-bawerk's explanation. Now a lot of Austrians therefore concluded that productivity had nothing whatsoever to do with interest, for the reason that boehm-bawerk gave when he demolished the naive productivity theory. Boehm-bawerk himself actually didn't go that far. In his own theory, he thought there was a role for what he called the technological superiority of roundabout production processes. So I'm not going to get into it here. I just want to point out that boehm-bawerk thought that empirical facts about production and capital goods and how you could use your labor to either make goods right now, or you could use your labor to go first make capital goods and then yield consumption goods in the future, that those sorts of empirical facts he thought would influence people's valuations of present versus future goods. Okay, so ultimately the fundamental fact is if you value present consumption goods more than future ones, you're going to have originary interest. Boehm-bawerk thought, though, that technological facts about capital goods and how they're constructed and things like that could influence those valuations. And so that's the way he thought ultimately productivity considerations, if you want to think of it this way, could come in through the back door. Whereas people like Mises, if you read Mises' treatment of boehm-bawerk on this issue in Human Action, he basically says boehm-bawerk was a genius, he paved the way for us. Unfortunately, at the last moment, he fell short and relapsed into the very errors he had exploded earlier in his volume, something like that. All right, so that's what's going on there, and but it's far too nuanced for us to get into now. Also, a lot of people in the audience wouldn't agree with what I would say, so I'll move on. Okay, I think I could take this down at this point. Let me spend another 5 or so minutes, and then I'll open it up for questions because I realize there's a lot of material. In the Austrian view, you have to distinguish, or there's a distinction between interest and profit. So you've got capital, and you can see the sense in which it's associated with interest, and in the sense also in which it's not. And I think those examples I've shown you the subtleties there. And if you remember on that first sheet, I showed that the classical economists thought that capital was the factor that earned either profit or / interest. So let me just spend a little bit of time right now discussing the distinction from the Austrian point of view. Because I notice on the schedule, I'm sure Dr. Salerno, I think it's in tomorrow's lecture, there's one where you can choose between entrepreneurship, where he gives it, but it's an optional, there's something else you could go to. And so let me make sure that you hear this if you happen to choose the other lecture. In the Austrian view, even if everything were fully known about the future, there were no uncertainty, if you were in what you could call long-run static equilibrium, or what Mises calls the evenly rotating economy, even so, the factors of production would not get paid prices that totaled up to the prices that were paid, that the consumers paid for the finished consumer goods. Okay, so you've got that chain, that pipeline of production, the higher orders that then are used to produce lower order goods, and finally to produce consumer goods, that the prices of those consumer goods, even though they're causally related to, even though the prices of the final products, as Dr. Herbner explained, are what logically the entrepreneurs are thinking about when they then decide, well, how much am I going to pay this worker? Because he's going to go to my factory and he's going to help produce television sets, and I'm looking ahead in the future and I think consumers will pay $120 for each one of these TV sets, so how much, is he worth to my firm? When they do these sorts of calculations, they're actually discounting those future revenues by the rate of interest. Okay, so depending on how far in the future those revenues will accrue to the firm, they get discounted. And so if somebody is going to work for me whose product is only going to become available 10 years from now, his contribution gets discounted more heavily than somebody who's going to work at a hair salon and the services they provide are immediately transformed into finished consumer goods. All right, so there's this discounting is inherent in the entire market process, and when entrepreneurs go into the factor markets, they take that into consideration. Now, they might not see the whole structure of production, that somebody who's buying fifth-order goods in order to transform them into fourth-order goods and then sells them to the next person, they might not have anything to do with Austrian theory. They might not even be seeing the world that way. That person might think of his customers as, he makes tires for 18-wheelers, and he might just view his customers as the companies that have fleets of 18-wheelers, and he doesn't think of it in terms of first-order, second-order goods. Of course not. And so from that point of view, he might be viewing the tires as the finished consumer good, but in terms of Austrian theory, probably we would say no, that those 18-wheelers themselves are used to ship groceries from the farmers to the stores, and so the 18-wheelers themselves are high up in the production chain. But the point is, at each stage, this discounting occurs, and so what happens is the sum of the prices paid for, let's say, fourth-order goods do not add up to the revenues that they get when they sell the finished third-order goods to those particular buyers. And so these prices have a discounter. There's a gap, if you will. And Murray Rothbard, if you're interested in this, I can, if you want to talk to me later, send me an email. I can point you exactly where in Rothbard's Man, Economy, and State. He's got some great graphical illustrations of this. But the point is, even if there's no uncertainty, if everything is totally anticipated, you get this discount on future goods precisely because of the fact that present goods are more valuable than future goods. All right, so it's not just about uncertainty. Now, where uncertainty does come into play, and this is what the Austrians think that entrepreneurs earn. So the entrepreneur, he goes into the factor markets and he thinks that there's a mistake that's been made. He buys up factors of production that collectively will sell for a certain amount. He transforms them into a product and sells them to consumers, and he gets so much money from that that even when you take into account the fact that he bought claims on future goods and then waited for them to ripen into present goods and sell them, even accounting for that gap, he's earned over and above that. And so that's what the Austrian would call pure profit. All right, so I guess all I want to stress here at this point is pure profit is earned because of uncertainty. That it's the return to entrepreneurship per se, where the entrepreneur is better anticipating the needs of the consumers, and so he can see where he can forecast and say, I bet consumers would pay such and such for this service or this product. I can think of a way that I could produce it, and the amount of money I would have to spend on inputs in order to produce it, even accounting for the time difference for the originary interest, is less, so that I would still have money left over. All right. Now, if that's the case, the Austrians would say we're not in a position of long-run equilibrium. That if that's the case, it's because other entrepreneurs must have been off the ball. They must have made a mistake in not seeing this opportunity that this particular entrepreneur did. Because if they did see it, they would have bid up the prices of those factors so that the only gap that remained was the one due to pure time preference. All right, so that's the distinction. So in the real world, when you see an entrepreneur or a company reports its earnings, and it's, they might say GE made such and such profit last year when you read a newspaper account, that doesn't mean economic profit. That's not the return to entrepreneurship. What that means is their revenues were higher than their money costs, and so that's accounting profit. And so that includes the return on capital. That's the fund out of which the investors are paid dividends if they get dividends, or there's reinvestment going on. So the numbers that we see in the real world, all we have to go on are the objective market prices, and that includes the return both to interest or the time preference fact, and also if there's a gap there even left over, then that's the return to pure entrepreneurship, to the entrepreneur better forecasting the future. So in practice, we can't separate them out, but analytically, we can distinguish between those. And that's the whole reason that Mises has this construction that he calls the evenly rotating economy, or what you could call long-run static equilibrium, if you want to use that kind of terminology. So the point of that Mises makes clear, the reason he goes through that thought example to say, suppose all the entrepreneurs correctly forecasted the future, nobody made any mistakes in judgment, nobody ever had any errors, nobody regretted what they had done. If we were in a situation where day after day this situation played out, what you would have is laborers would still earn wages, landowners would still earn rent, people who owned capital goods would still earn incomes off of those capital goods, and when they wore out, they would go and buy new ones. So you could see this stuff happening, and there would still be something left over, this gap, this shortfall between the prices paid for the inputs and the revenue received from the final product, and that would just be pure interest, and that would be due to time preference. All right, so Mises goes through that whole scenario and imagines that so that he can then distinguish that income from the gain to the entrepreneur for their superior forecasts. Okay, well, that's a lot of information I've thrown at you. Why don't I take the remaining time for questions? Yeah, the striped shirt.
From a financial standpoint, are you saying that really the time preference for money, is that the same thing as the time value of money in financial, in the area of finance, as when you look at a return?
Right. Okay, I'm going to repeat the question just to make sure people online can hear. So the question is in the Austrian view, the time preference explanation for interest, is that the same thing as if you take a financial engineering class or an accounting class and they talk about the time value of money? When people are talking about the time value of money, what they mean is that you can earn a return on money. So that if let's say somebody owes you money, like you have you're the phone company and someone's delinquent in paying you, they can get a collection agency, and I know somebody who works for a collection agency, and he said, we call these people and we remind them of the time value of money, that you owe somebody $500, and you say, yeah, I'll pay you back, don't worry about it. If it takes you 3 years to pay them back, you're not just inconveniencing them, they're losing money because there's the time value of money. They could take that money and invest it somewhere and earn a return. So the point is, future money is worth less to you than present money. When most people use that phrase, they are assuming because there are these investment opportunities, you can invest in a bond, for example, and earn a rate of return. So the Austrians are going the other way. The Austrians are trying to explain why is there a time value of money, and they're going to say it's more fundamental. There's this time preference that, yes, other things equal, you would want to get a $20 bill now rather than 10 years from now, but you would also want to get an apple now rather than 10 years from now. Most Austrians are, generally speaking. So they're trying to explain why it is that there's positive returns on investment projects. Any other questions? Yeah.
Okay. And determining the rate of interest within a market, is that sort of the same thing as establishing the consumption savings ratio? So when you loan to the capital goods market, generally when people save more, the rate of interest falls as a result of the consumption savings ratio. I can kind of understand that conceptually, but as far as going out into the marketplace and looking at the production process, actually determining what that is in objective percentage terms,
Okay, so the question is, what does the determination of the rate of interest have to do with the consumption savings ratio? Is that a fair summary of your question?
Also, I mean, just determining what the rate of, going out into the marketplace and determining what the rate of interest is.
Okay.
What is my expected rate of return at this point in time in the market? Because that's obviously fluctuating.
Okay, and how does it relate to the expected rate of return? So, if I'm understanding, no, there's not a definite one-to-one relationship where I could say if the rate of interest is such and such, then therefore the consumption savings ratio is going to be this particular amount. What is true, though, is in the Austrian view, people's time preferences, in other words, their preferences over present versus future goods, and the degree of that advantage or that superiority influences how much they save versus how much they consume in the present. And so, of course, if people are very impatient, if they have a very high time preference, then they're going to, other things equal, save less and consume more. Whereas if their preferences change, if they become more patient, more anxious to provide for the future, then Austrians would say their time preferences have fallen, and they would then save more. But there's not a numerical relationship. Yeah.
Could we say, in some sense, that everything is a capital good? Because, for example, I work and I make pumps, which are obviously capital goods, but I have to eat in order to live and to work. So, in that sense, could we say things like food and cars are capital goods? Is that?
Right. I don't know if you could say. So the question is, can we push it, and couldn't we count just about everything as a capital good? Yeah, you're right. I think Rothbard even talks about this, that clearly the loaf of bread, when it's sitting on the store shelf, you want to say is a capital good. But then when the consumer buys it and puts it in his car, does it turn into a consumption good? Well, I don't know, because you then take it home and you use it to make a ham sandwich. And so at what point, and even the ham sandwich on a plate, maybe then it's just a means to the end of satisfying your hunger, or the taste, or whatever it is that you want. So you're right. I think it's more of a, there's no right or wrong answer to that. Depending on how you want to define it, you can certainly consider it to be a capital good or a consumption good. I think most Austrian economists, though, they cut it off and they say, well, the last point at which money changes hands, that's usually where, that's a good a point as any to say, okay, now it's a consumption good. So since you're not charging yourself to make yourself a ham sandwich, you're not going to call that a consumption good that turned into the finished product for your future self. But you could think there's nothing wrong with thinking like that, but you have to draw the line somewhere for the analysis to work. And so I think usually they draw it where the last transaction against money. Yeah. Mm-hmm. Yes, yes. So the question is that in those diagrams I was showing, it was land, labor, and capital goods were all collectively producing this consumption good, and I was saying it was the time difference that was causing the interest. So are you saying that it's not just the capital goods earning the interest, it's everything? Is that kind of what you're getting at?
What I'm saying is that it is the time component of the capital goods that earns the interest, because it's like a package of labor plus land plus natural resources plus time.
Oh, right. Yeah, that is one way of thinking about it. Some authors have even said that not only do you have the capital goods, the land, and the labor, but in a sense you're adding time. And so you can go ahead and do, and some neoclassical economists do this, that they're just viewing time as a separate input and it has its associated price per unit. And if you try to do it that way, you can get some results. I'm not going to be able to do it justice right now, but boehm-bawerk does, I think, refute that approach. That he shows there are certain problems with thinking along those lines, and he thinks it's easier just to start up straight up and say, no, you want to think of it in terms of present versus future goods, and they have different valuations, that there's not this separate input called time. Okay, but that there's nothing immediately objectionable about thinking like that. He just thinks it's more straightforward to treat the time element not as a separate input, but in terms of preferences over the goods. Yeah.
How adequate and correct are Hayek's corrections of boehm-bawerk in your theory of capital?
Okay, so the question is, how are Hayek's corrections in terms of boehm-bawerk and the pure theory of capital? I'm going to have to say I haven't read that since grad school, so I don't remember. Hayek, yeah, that's a really difficult book, and you're going to think I'm cheating, but I think some of the stuff he says is right and some of it's wrong. And I won't tell you which. Any other questions? Yeah.
The naive productivity theory,
Mm-hmm.
is that necessarily at odds with Merdner that we learned earlier today about the marginal productivity analysis?
No. So the question is the naive productivity theory that boehm-bawerk objected to, is that consistent with the marginal productivity theory? And so no, the Austrians reject the naive productivity theory of interest, and they believe in the marginal productivity theory. So that's, I don't know if this was stressed in that lecture, but you have to take the time element into consideration. Once you do that, it's fine. So remember, in that diagram where I was sort of setting up the interest problem, at first boehm-bawerk was framing it as, why is there this undervaluation of the factors of production? But once he came to his answer, he realized there isn't an undervaluation at all, that those factors are being paid their contribution, but right now they're, in a sense, creating a future good. And so once you realize future goods are worth less on the current market than present goods, they are getting paid their marginal product. All right, so for example, this is another great illustration. Boehm-bawerk goes through and he destroys the exploitation theory of interest. And so Marx, he explained the interest that capitalists earn, because he said what happens is the capitalists hire workers and they don't get paid the full value of their product. They get paid a discounted amount. They get paid a certain amount even though 10 years down the road, when the product ripens and the consumers buy it, the capitalists earn more from selling that than they paid the laborers the representative portion of earlier when the labor was performed. And boehm-bawerk goes through and he shows that no, that's not true, because when the laborers first performed the labor and that thing was still a distant good 10 years in the future, at that point it was a future good. And he said the way to prove this is that the laborers want to just own the intermediate products themselves and then sell it 10 years from now. They can get the full value of the product. Or if they want to take their wages that they get, the spot wages that they get paid on the moment, and if they want to go put it out in a bank and earn interest, it will grow exponentially into the full value of their product when the thing actually gets sold to consumers. And so the point is, if you think about that, if you're laboring on something, let's say, someone's going to build high-rise apartments, hires a bunch of workers to clear out, to dig a huge hole for the foundation, that the work they're doing right there, that's not directly helping anybody. A big hole in the ground is not useful. But what they're doing is laying the groundwork literally for apartment buildings that might be there 5 years from now. And so what they're getting paid at that moment is only a discounted value of what their labor would be worth, in a sense, if it were all performed the day that the apartment rise opened up for business. And so if they could take those wages and lend them out at interest, if they don't mind about waiting for the time component. But the point is, the socialists wanted to have it both ways. They wanted the people to be paid right now what their labor would be worth in the future when it ripened into consumer good. So to answer your question, no, there's no contradiction there between the critique and the marginal productivity theory. Okay, thanks.